Let's look at one more example where we're changing, not depreciation methods, geez, it's been a long day, where we're changing inventory methods because there's something we would be amiss if I didn't mention, and that's the impact that this may have on our tax liability. When we're using FIFO in this problem or in the last problem, typically our tax income and our accounting income would have been the same if there were no other differences, of course. So we would not have any need for a deferred tax asset or deferred tax liability. But when we do this change in method, that creates a difference between accounting income and taxable income. Therefore, we may end up creating either a deferred tax asset or a deferred tax liability. So hopefully when you're watching this, you've already went through a chapter where it talked about deferred tax assets and liabilities, as my students have, so that we can see this. Now this problem does have a lot of information, and I don't know that we need 100% of it to do this first little part of the problem, but let's walk through. The Rockwell Corporation uses a periodic inventory system and has used FIFO cost method since inception of the company in 1979. In 2018, the company decided to change to the average cost method. Data for 2018 are as follows. Now, you may be wondering, why in the world did they change now? I have no clue. I don't work for this company, but, they are, so we live with it. So here we go. Beginning inventory under FIFO was 174,900. Then it tells us our purchases, our cost of goods available for sale, and then how many we sold. Okay. Now, if we needed to, we could find the average cost, but we don't need to at this moment. The company's effective income tax rate is 35% for all years. The company had used, if the company had used the average cost method prior to 2018, ending inventory for 2017 would have been 153,700. And then 7,300 units remained in inventory at the end of 2018. So they told us what was sold there and what was left at the end. Prepare the journal entry at the beginning of 2018 to record the change in principal. So the biggest thing we need to find is really how much would inventory have changed by? Because once we have that number, we know that expense would have changed by the exact same amount. Logical, right? So it tells us that the end of 2017 under average cost, we would have had 153,700. Well, how much did we actually have under FIFO? Well, all we got to do is look at our beginning inventory for 2018. This would have been our ending inventory under FIFO, 174,900. So really, to answer this first part, the only thing you need to do is take the 174,900 because it tells us what our ending inventory was under FIFO. Then we take that from the 153,700. And what that's going to give me is the actual amount of change, and that was 21,200. So our inventory account would be different by 21,200. So therefore, we need to adjust my inventory account, and we need to adjust it down. That's the reason I'm crediting it. I guess I should have denoted that before I just did a journal entry. Notice we have 174. We need to take it down to 153, so we need to credit inventory. Inventory is an asset, and we need less in assets. So that brings it down. Now, all of that is expense, but we've got to be careful because remember, when our expenses change, so does our taxes. So what we would need to do is find what's the tax impact of that change. Well, we know, let's see if I can get another little line here. Nope, undo. Let's just put it right here then. All right, so we know that our difference between our expenses now, FIFO and average cost, would have been 21,200. Then we have to find our tax savings or tax difference, and that would be multiplied by the 0.35. So in other words, had we been able to deduct this from our taxes, it would have saved us 35%, but we were not able to, okay? So we multiply that out, we find 7,240 is our number there. So think about it this way. As your expenses go up, in theory as a business, your taxes should go down. So now we've reported more in taxable income than we would have in accounting income for that year. So in the future, this will actually save us money, okay? Because we'll be able to eventually expense this inventory as it's sold in later periods. So when it's going to save us money in the future, we call that a deferred tax asset. So we can't just say, hey, the entire change was a result of the cost of goods sold, because when we change cost of goods sold, we also impact taxes. So we need to take that into account. And then where do we find our retained earnings? Well, it's the remaining balance. So let's see here, pull up our calculator. We're going to take our 21,200, excuse me, and we're going to subtract our 7,420. That gives us 13,780. So that would be the net change that we would need to hit to our retained earnings to fix prior years. Okay, so again, it's very much like the last problem, but in the last problem we ignored the tax impact just so that you could understand the overall change. But we do have to keep in mind that this may create a tax difference between our accounting income. So even though our interest expense, or excuse me, our inventory, our cost of goods sold expense was would have been different in the prior year because of our tax savings or tax expense, it offsets some of that difference. So we have to take into account and correct for the tax issues to start with. Okay? Now, what will they do next? Well, Rockwell will recast its financial statements to appear as the average method always had been used. This will include reporting cost of goods sold in the income statement and inventory in the balance sheet for 2018 using the newly adopted average method. So let's go in and figure out in the comparative financial statements what will be the amounts of cost of goods sold and inventory reported for 2018. Well, let's first just find the cost of ending inventory for 2018. And how would we do that? Well, that's pretty easy to do here. What we would need to do, excuse me, is take our cost of our inventory. Now keep in mind though, we have to be a little bit careful here because our cost of good available would not be 609,500. Because remember, this beginning inventory is under FIFO, but we need it to be under LIFO. So, or excuse me, not LIFO, average cost. So before we can do anything, the first thing we need to do is find our actual cost of goods using the average cost method. So we would have came in with the 5,300 units, but not at $33. That would have been the FIFO. But we came in at 153,700. Then we would add our purchases of 434,600, and that's going to, update our numbers just a little bit. So if we add those two, let's see, we get 588,300. So this would be our cost of goods available for sale under the average cost method. Excuse me. So what would I do then? Well, under average cost, to find your average cost per unit, you take total units divided, or excuse me, total cost divided by our total units. So our total cost here is 588,300. We're going to divide that by our total units, and how many units do we have in total? 53 plus 53 plus 53, 15,900. That's easy. All right, so when we divide that out, we get $37 per unit average cost. All right, so to find your ending inventory, all we have to do is take that unit cost, 37, and to find our ending inventory, let's put it right here, we had 7,300 units, I believe it was. Yes, 7,300 units remain, so we take 7,300, and we would multiply that by the $37 per share, and that would give us our ending inventory of 270,100. So that's the first step. Now be careful. A lot of times people will just take that original number, what was it, 609,500 that was here. But keep in mind that has a beginning cost at FIFO. So you first have to fix this from FIFO over and then add to get your actual cost of goods available under the average cost method. So you do have to recalculate this first little section to find that. Then you simply take that, divide it by the number of units, and that gives you $37 per unit. You can multiply that by the 7,300, and that gives you your ending inventory. Now, the last thing it wants is the cost of goods sold. What would we report as cost of goods sold? Well, the easiest way to do that then is just back into it. Okay, what does that mean? Well, we know we had 588,300 available. We have 270,100 in ending inventory. So to find our cost of goods sold, what we would do is take through 588,300, subtract out 270,100, and that's going to give us what? Let's look it up here. So 588,300 minus 270,100 gives us 318,200. So that tells us what our cost of goods sold would have been under the average cost method. Okay. So anyway, I know this problem is a little disjointed, the way they're asking some of the questions, but I did want you to see and understand that when we have these changes in our accounting principles from one method to the other, it is possible that there is a tax implication. So you have to figure out what's our tax impact of that before you do or while you're doing your adjusting entry. You can't just go from retained earnings to inventory like we did in the first problem if a tax difference arises. So make sure you're paying attention to that in these problems if there is tax consequences of the change. All right. All right. Well, I hope you have a wonderful evening. Take it easy. And again, sometimes my videos seem a little disjointed because I'm talking to myself into a computer screen. So it's a little different than being in front of people where I can actually interact. So hang in there. I hope you all have a wonderful evening.